what do you think about the president's renewed attacks on the Federal Reserve yesterday? Jay Powell's going to be in front of Congress today. It'll be a chance to respond. I'm not sure he'd want to.
I don't think it was productive myself. I think, though, in the sense the president was right, in the sense that maybe the Fed did go a little too far, and they've essentially acknowledged that by backing off with 3 cuts now. But I think basically the chairman is pretty happy with the level of rates now. If you're on the Fed, you say, what's our job? Our job is to have low unemployment and stable prices, and that's right where we are. So I think the policy now is about right, and they're now ready to make a further move only when the data either gets much better or deteriorates.
Which means what for the markets?
I think the market is basically, that's the consensus. So if they just do nothing for the rest of the year, pretty much the markets have already baked that in. If they were to make another cut in December, I think at this point that would be a positive surprise.
A positive surprise because, or you don't think that would be interpreted as a sign that the Fed sees weakness that we hadn't anticipated?
No, because I think the data has actually turned, especially outside the United States, in the course of the last couple of months. And U.S. data continues to be pretty strong. Fourth quarter, the estimates are all over the place, but it'll probably be around 1.5. But it looks as though the bottoming process is in, and a lot of the data has started to show a little bit of recovery next year.
Michael, you think it's upward for stocks from here? If Ed's right, if the bottom is in?
Well, I think that stocks have already done quite well, and frankly, they're pretty fairly valued right now. They're not expensive exactly, but if they rally substantially into year-end, as often happens at this time of year, it may be taking away a little bit from next year's returns. So we're not overly excited, but I guess you'd call me an optimist as opposed to a pessimist right now. Meaning
you wouldn't be buying stocks, but you wouldn't be selling either?
We're definitely not selling. We've taken some profits here and there in some of our names that have done really well, and we've been reinvesting in other areas. So we're still at least neutral to slightly positive on stocks relative to everywhere else. It's bonds that are very expensive, but they're not going to change anytime soon.
Ed, you think that it's more likely that value stocks will outperform, not the growth stocks at this point? Why is that?
Well, there's a very wide spread in valuation between value and growth. So growth always sells at a premium, but that spread now is near record highs. It actually peaked in August. Value has made a comeback the last couple of months, but it's still, we think that value is where the opportunity set is within the market.
And where are you looking in particular in terms of value?
Well, we look at value everywhere. So our process looks at value within each sector of the market. So we're not just looking for cheap stocks, period. We combine value, growth, and quality. You can find that in every sector. But, of course, they're really concentrated in more value-oriented sectors like financials.
And are there names in particular you can talk about?
We can't for compliance reasons, so I'm sorry.
Okay. Michael, how about you? Where would you be telling people to go ahead and look, even though you're a little cautious at this point? Where would you be deploying some of that cash?
In contrast, I think that some of the stuff that's worked so far this year, consumer discretionary, technology, will continue to work. There's no reason that they shouldn't. They're not overextended. There are a few names here and there, but we still like a lot of the individual names in those spaces. Communication services, a lot of good companies in there. We look at industrials, and I think they've had a very good run, but they may have done as much as they're going to do for a while. Healthcare is cheap, but frankly, with a presidential election coming and they're a good whipping post for both sets of candidates, I don't see that doing very well. Energy, I think, is pretty well stalled for a while. So we're sticking with what's worked so far this year.
What about Ed's point that the spread between the value stocks and the growth stocks has really gotten exaggerated at this point?
You could have said the same thing a year ago or 2 years ago. I don't really define groups of stocks as growth or value because, look back to 2016, companies like Facebook, Amazon, Alphabet, and others were seen as value stocks because they were beaten up and cheap at that point, and we bought them then. I don't know that you'd call them value stocks today, but what we are looking for is individual companies that are priced attractively, and I don't get too caught up in those labels.
Hey, Ed, we have watched the markets run almost straight up. We made the point earlier that the major averages haven't seen 2 days back-to-back declines in over a month. That momentum, it keeps pushing higher and higher. Does that make you think you don't want to fight the momentum, or does that make you get a little nervous?
I think what we're suggesting is stocks will continue to work their way higher until we get the next recession, which we don't think is going to happen for at least a year and maybe a couple, 3 years down the road. We also do think that maybe at this point, it may be better opportunities outside. The United States has crushed other markets over the past 10 years. And now that valuation gap has gotten quite large. And the change in momentum of the economic data, we're pretty much stable, has been more dramatic there, where the things are starting to turn up. And so I think that maybe some better opportunities to finally to rotate outside the United States.